Hello students and welcome to the lecture. So students, as we know that we are covering the financial knowledge and the banking awareness part of it, and basically what we are discussing the FMC, which we also called as a forward market commission, right? So basically we have completed various things in this particular topic, like we have completed the act, which is the forward contracts and Regulation Act 1952. All right, that is the topic which we completed recently, all right, in the previous lecture. Also we have seen that it is comes under the Ministry of Finance, right? That is also we had discussed. All right, so these are the some kind of things which we have discussed in a thorough way. All right, so basically what we are going to do is that this is the topic which we were discussing. We had done with the definition part, we have done with the regulation part, we have done with the functions part, we have done with the commodity future market, we have done with the forward contract act. Now what we are left with is the interrogation with SEBI, commodity derivatives, and the summary part. All right, so let's begin our journey with these topics. So this is the topic we are going to cover: integration with the Securities and Exchange Board of India, in short SEBI. All right, so let's start. First of all, we have to look at the background. Prior to the integration, the SEBI was the regulatory authority for the securities and capital markets in India, while FMC was responsible for regulating the commodity future market. All right, now here basically we are talking about the two agencies. The first is the SEBI, okay. The second is the FMC. All right. Basically, if we talk about the SEBI, then SEBI deals with the securities exchanges, right? Whereas if we talk about the FMC, then FMC basically deals with the future market commodities, right? Okay, for securities, for commodities exchanges. Okay, this is the first thing. Second, they both having agreemental force. Okay, similar with the FMC one, agreemental force, it is similar to them. Okay, now we know why I'm saying that agreemental force in the FMC, as we have taken example of XYZ and ABC so many times, okay, in which they had signed an agreement for the particular unit, all right, for a predetermined price. Similar thing is with the SEBI part. For example, let me tell you, suppose if this is an individual and this is the organization called the XYZ, okay, so this particular person could be an individual, could be the organization, whatever. XYZ is basically a company. All right, so suppose if as I've told you, basically every company having the 100% shares, okay, 100% shares. But what they generally do, they generally offer their share in the stock markets, which comes under the SEBI. All right, so in stock markets, suppose if this person purchases the 10% shares or 10 shares out of 100, it means that he is now become a owner of 10% stakes in the company XYZ. All right, he is now become the owner of 10% stakes in the XYZ. That's it. Okay, now here's you can say typical conditions. Now basically this ownership has been transferred from this to this with an agreement, okay, which is also known as share agreement. All right, in this agreement there is a proper terms and conditions maintained and mentioned in the standardized way. All right, like how much dividend will he get, how much profit will he get, at what price he purchased it, at what price he will sold it. Okay, can he sold it to anyone, or the company will buy back the shares. All these kind of things have been mentioned in the agreement in the standardized way. I'm not going to discuss these things in details because we are not required to do this right now. Okay, we will have this kind of discussion in the money market form when we will taking the lectures of the other topics as well. Right now what I'm just trying to give an example. All right, so you can say this is an agreement form. All right, similar thing with the XYZ and the ABC, right? So now this is the picture I have created it for you. If you look at this carefully, what you have found it, you have found, all right, they both are dealing with the exchanges. Okay, in the future, not right now. Second, they both having the agreemental force, right? SEBI also and the FMC also. All right, so if these organizations which having a similarity in their options at some extent, but now they are working apart, if we combine them together, then it will lead to their high efficiency. All right, so this is the background. You can say prior to the integration, SEBI was the regulatory authority for the securities and capital markets, while FMC was responsible for the future commodity markets. Got it? Now let's move forward. The existence of two regulatory bodies for securities and commodities led to the differences in the regulatory standards, legal provisions, and the market practices. Because right now you are having two different entities. The first one is the SEBI, second one is the FMC. You having the two different entities, but their work is almost same. You can say they both are working for the exchanges and having the agreemental force. All right, so you can say when two different organizations works in the same field on the same manner, then there will be clashes like regulatory standards, legal provisions, and the market practice. Some of them may be from SEBI, some of them may be from FMC, both having different regulations, different rules, different oversights, but when their parties get combined together, it will be a, you can say, obstruct condition. Why? Because they having the different things. All right, so this is make it very necessary to combine these together so that there will be a similarity in this kind of things. Thereafter we have the regulatory consistency. To create a consistent regulatory framework across all financial markets, eliminating discrepancies between securities and commodity markets, it has become very essential that they should be integrated with each other. All right, because we required a consistency in the regulatory framework, because as I have told you, when two different organizations which are working together in a very similar manner, they having the different regulations and the oversight, this will create an obstacle situation in the market. Second is eliminating discrepancies between securities and the commodity exchanges. Okay, because they both are having a similar kind of structure, so that there should no discrepancies between them. Okay, thereafter what we have the concept of risk management. To strengthen risk management practices and improve transparency in the commodity derivatives, bringing them in the line with global standards. All right, because right now they both are not clashing together in the standard terms or other terms, but now right now they are having the similar course of action to be done. All right, so it's basically strengthen their risk management practices and improve the transparency, because right now no one can claim that he is from FMC, so why he should follow the SEBI. Okay, similar thing could be applied here also, no one could say that he's from SEBI, then why he should follow the FMC. All right. So this is the first thing. Second, if we combine together, that it means that their efficiency will be higher. Okay. So if their efficiency will be higher, it means that their quantitativeness at global level will be enhanced. All right. So this is the main thing. Now let's move forward. Second is the investor protection. It is another provision. Okay. So to enhance investors' protection by ensuring that similar rules and safeguards apply to all market participants, regardless of whether they were trading securities or commodities. Like as I have told you, suppose this is the SEBI, this is the FMC. All right. SEBI is basically trading in the securities market. FMC is basically trading in the commodity market. Okay. But both of them is a part of economy and common market industry. All right. Common market industry. This thing is very common. All right. So it means that the rules and safeguards must be applied to all market participants, regardless whether they were from the securities trade or from the commodity trade. Okay. This thing should be removed or revoked from them. All right. Thereafter, we have the reducing regulatory arbitrage to eliminate opportunities for regulatory arbitrage where market participants could exploit regulatory differences to their advantage. Okay. So you can say, suppose SEBI having its own regulations, similarly FMC having its own regulations. All right. So who will be benefited by this? Obviously, the market participants who are intended to take the negative advantage. All right. So you can say their integration is very, very required to stop the exploitation of regulatory differences to someone's advantages. All right. Thereafter, what we have? Under the integration plan, FMC ceased to exist as an independent regulatory authority. Instead, the regulation of commodity derivatives was transferred to the SEBI, making SEBI the single regulator for both securities and commodity derivatives. So this is an important topic. First, the FMC was separate. Thereafter, the SEBI was separate. Okay, but when they both get, you can say when they both get merged together or you integrate together. Okay, thereafter only SEBI comes out, and right now SEBI is having the SEBI is having the force for both, for the commodity market as well as for securities market, for both. All right. So please remember this thing also. All right. It's FMC, it's SEBI. So when they get merged, only SEBI comes out, and SEBI having both commodity and the securities market holding by it. All right. So keep this thing in your mind. Thereafter, SEBI took over the functions, the responsibilities, and the regulatory powers of the FMC, including the supervision of commodity exchanges, regulation of commodity brokers, and the oversight of trading and settlement processes in the commodity derivatives market. Okay, so it is a very important thing which I have shown you just right now. The question may be asked you, when the SEBI overtook the FMC due to the integration, so what are the things which had been taken over by the SEBI from the FMC? This becomes a very important topic, or the question you can say. Okay, so you could say that the functions of the FMC, the responsibilities of the FMC, the regulatory powers of the FMC, okay, these all have been transferred to the SEBI. Okay, thereafter, this includes the supervision of commodity exchanges, regulation of commodity brokers, oversight of trading and the settlement process in the commodity derivatives market. These all are the part of this thing, and this has been transferred from FMC to SEBI. Okay, so remember this thing also. The integration aimed to create a unified regulatory framework for all financial institutions, regardless of whether they were securities or commodities. Alright, so you can say the integration aimed to create a unified regulatory framework for all financial instruments, regardless of whether they were securities or commodities. This all become a part of unified regulation. Why? Because right now they are no longer SEBI or the FMC separated, which are operating. All of these become the common part of SEBI. So you can say only right now SEBI having the power. So that's why it's having the unified regulatory parts. Okay. The framework included rules related to the trading, clearing, settlement, risk management, investor protection, and market conduct. Now it is very important to know about which are the rules which have been included. First is the trading. Okay, second is the clearing, third is the settlement, fourth is the risk management, fifth is the investors protection, and seventh is the 6 is the market conduct. So you can say these are the 5 important aspects of this thing. So you could also understand it like what are the 5 aspects which have been transferred. First is the trading. Okay, trading means signing of the deal, meeting, communication, whatever. Thereafter, second is the clearing, like clearance of payment and all. All right, clearing. Thereafter, the settlement. Okay, like settling the payment dispute between the two parties. All right. Thereafter, the risk management. It means, as I have told you, manage the risk properly. In the previous lecture, we had discussed it in the detail, so you can also check it from there. Thereafter, what we have the investors protection. Okay, like the investors who invest in the securities or the commodities, his rights must be protected. And the last, we have the market conduct. It means that transparency of the market must be ensured. Okay, so these are the 6 proper provisions of the new unified regulatory framework. Okay, and the operator of them is our SEBI, stands for Securities Exchange Board of India. All right. Thereafter, with the integration, SEBI expanded its scope of operations to encompass commodity markets. This move allowed SEBI to leverage its experience and the expertise in regulating securities market to strengthen oversight in the commodity derivative space. Okay, so you can say Once the SEBI and the FMC get, you can say, integrated, the SEBI expanded the scope of operations to encompasses commodity markets, because right now this is also be planted with the SEBI. Move allowed SEBI to leverage its experience and the expertise in regulating securities market to strengthen oversight in the commodity derivative space. Got it? Now, SEBI could now enforce consistent rules and standards for margin requirements, position limits, and surveillance across all assets classes. So please keep this thing in your mind also. For margin requirements, for position limits, for surveillance across all assets classes. Alright, now this is the power of SEBI. Okay. Thereafter, what we have the market development. The integration facilitated the development of the commodity derivatives market by instilling investors' confidence and making the regulatory environment more robust. Encourage new participants to enter the commodity markets, improved market infrastructure, and contributed to the growth and development of these markets, because right now they having the unified regulatory framework and all the expertise of SEBI is now applicable in the market development. Okay. Now the challenges and the transition period. The integration did present some challenges as market participants needed to adapt to the new regulatory environment, because suppose the one who were already under the SEBI regulation, okay, they are already adapted, okay, but those who have been transferred from FMC, these are not adapted. Alright, so because of this, these people required no adaptation. No adaptation required. But that person or that people required a adaptation. Why? Because these people are already aware about the regulatory framework of the SEBI, about the procedures and all, but these people, they are generally not aware about this kind of things. It means that they required a proper time to get adopted to the rules and regulations and the policies, right? So that was one of the major challenge that the market participants who were previously under the control of the you can say FMC, they are now to be adapted to the new regulatory environment posed by the SEBI. Okay, so keep this thing in your mind also. Thereafter, we have the transitions period were provided to help market entities adjust to the unified regulatory framework, ensuring a smooth shift from FMC's oversight to the SEBI's regulations. So you can say when the FMC transferring to the SEBI, then it was not a hard fast transition. Okay, whereas it was a you can say gradual shifting transition. It means that an appropriate time, a proper time has been given to the investors, to the participants who were previously under the control of FMC, so that they could adapt it themselves as a part of the SEBI. Alright, so please keep this thing in your mind. The transition period was a adequate period for the adaptation process, and the transition is not a soft and sweet or the hard and fast. Okay, now what we have the commodity derivative segments of the SEBI. All right, so let's start. Overview. The integration of the Forward Market Commission with the Securities Exchange Board of India brought the commodity derivatives segment under the purview of SEBI. This marked a significant development in the regulation of financial markets in India. Okay, like first is the first thing which has been provided by this, you can say, integration is the Unified Regulatory Authority. Okay, with the integration, the commodity derivatives market, which includes the trading in various commodities such as agricultural products, metals, energy, came under the regulatory authority of SEBI. In the previous lecture also, I had told you, when we talk about the future commodities, okay, then basically we are talking about which type of commodities. Basically we are talking about, you can say, time taking, commodities. Okay, the commodities which could not be available to the customer right now or the immediate basis. For example, we have taken example. Suppose if you are went to the market where you are having two hoodies. First hoodie is at hit retail. Okay. Second hoodie is at customization. Okay. In the previous lecture, when I told you this particular person who went to the market, okay, who went to the market, if this person goes for this hoodie which is at the retail, it means that the person could have the particular hoodie on time. All right, but if that person goes for the hoodie customization, it means that he wants it in a form that something written over it, like you can see hustle is written over here. All right, this kind of things. So at that time the hoodie is not immediately applicable, right? Okay, so the immediate availability of that hoodie couldn't be promised, okay, or given. It requires a time, right? So same thing I had told you, the future commodities are those commodities which could not be available to the customer or the particular person on the immediate basis. Okay, so please remember, these commodities basically comprises the agricultural products, metals and energy. Okay, in energy we basically talk about the crude oil and natural gases and other fossil fuels. All right, SEBI, which was originally responsible SEBI, which was originally responsible for regulating the securities and capital markets, assume the regulatory responsibilities for both securities and the commodity derivatives market, as we have seen right now that the FMC plus SEBI provided us SEBI with the responsibilities of securities market and provided with commodities market also. Got it? So the merger of FMC and SEBI provides us this. Okay, so keep this thing in your mind. Thereafter, Transfer of regulatory functions. Okay. SEBI took over the functions, powers, and the responsibilities. Okay. So the question asks you, after the merger, how many things have been taken over by the SEBI from the FMC? So they are the three things we have seen in here. Okay. So like you can say functions. Thereafter, what we have? Powers. Then we have the responsibilities. All right. So these are the three things which have been transferred to the SEBI from the FMC. Got it? So keep this thing in your mind. This included overseeing commodity exchanges, commodity brokers, and all aspects of trading and settlement in the commodity derivatives market. Thereafter, what we have the consistency in regulation. The integration aimed to create consistency in the regulatory framework across all financial markets in India, as we have seen, because there were two different organizations, the SEBI and the FMC, which were dealing in the exchanges and having the agreemental force, but they having the different regulatory frameworks, which is the bone of contention in the market forms. All right, so please keep this thing in your mind. By having a single regulator overseeing both securities and the commodity derivatives, the government sought to eliminate discrepancies in the regulatory standards and promote a level playing field for market participants. Because right now, you can say surveillance is concentrated, because in the previous case when there are two bodies, the surveillance is, you can say, divided. But when we have only one body, then you can say the surveillance is concentrated. Okay, so this basically helps us in eliminating discrepancies, the regulatory standards, and promote a level playing field for the market participants for fair and transparent opportunities. Okay, so keep this thing in your mind. SEBI leveraged its expertise and expertise from regulating securities market to bring similar standards and best practices to commodity derivatives segment. Okay, so it is the you can say benefit of regulatory alignment. This alignment means that the rules related to margin requirements, position limits, risk management, investors protection, and the market conduct were consistent across both securities and the commodity derivatives. Please keep this thing in your mind when you revise this particular lecture. Margin requirements, position limits, risk management, investors protection, and the market conduct. Okay. SEBI's involvement in regulating the commodity derivatives segment was expected to enhance market integrity and investors' confidence in these markets. By applying a robust regulatory framework and the surveillance mechanism, SEBI aimed to prevent market manipulation and the irregularities, ultimately providing a safer and more transparent trading environment for all participants. Market development. The integration facilitated the development of the commodity market derivatives, okay, allowed for more efficient use of SEBI resources and expertise to develop and promote commodity markets alongside securities market. A unified regulatory approach encouraged new participants, increased the liquidity, and supported the growth of derivatives trading in India. Now, challenges and the Transition from FMC's regulatory framework to the SEBI's oversight did present some challenges for market participants and the entities involved in the commodity derivatives markets, as I have told you, because previously they were under the control of the FMC. They were familiar with the regulatory oversight of the FMC, but then they have to be transferred to the SEBI. This will take a you can say swift shift. All right, so that's why it was a gradual transfer situation, not an immediate transfer situation. All right, so keep this thing in your mind. Thereafter, to address the challenges, transition periods were provided to help market participants adapt to new regulatory environment and comply with the SEBI's regulations. Okay, so you can say due to the gradual shift, they got a proper chance to become adapted and understand the new regulatory environment, and so that they could comply with the SEBI's regulation. Okay, now the summary part we have. In summary, the transfer of the commodity derivatives segments under SEBI regulatory authority was a significant step in aligning and unifying regulatory framework for all financial markets in India. It aimed to create consistency in the regulatory standards, enhance market integrity, and contribute to the development of commodity derivatives market. Okay. SEBI's experience and expertise from the securities market were leveraged to ensure that the regulatory oversight for commodity derivatives was efficient, effective, in line with the international best practices. So students, with this we have finished the FMC part. All right, please revise the lecture properly so that you could have a command on the topics in a proper manner. All right, by the continuous revision and the practice, you will find yourself at a better place in comparison with those who will give the examination with you. In short, you can say that you will have an edge over others. Okay, so this is my humble request to you. With this note, let's end this lecture and say thank you.